Since 1987, we've helped investors navigate the markets using technical research focused on relative strength, supply and demand, and momentum. From sector rotation to asset class rankings, we highlight what drives performance. Nasdaq, Dorsey, Wright, helping you stay one step ahead.
Hello, everybody, and welcome to this week's podcast for the week of July 23rd. My name is Miles. I'm joined here by good friend and colleague Trevor Plesko. How you doing, Trevor?
Doing all right. Can't complain too much. Some of the smog from that Canada wildfires kind of finally blew over here in Richmond, Virginia. So a little bit more sunny, despite some rain today, I guess, over the last
a
week.
little bit more sunny. It hasn't been sunny at all. It's just been raining.
Hey, it's sunny a couple of days ago, but
we both walk to work. We're local to the Scott's Addition in Richmond area, and it has been torturous getting to and from work. It almost feels like you're in a monsoon. So hopefully we can get all the rain out of the way. I've got a wedding coming up that I'll be part of in just a few weeks. So come on, rain on down, and we can have good weather on.
Hopefully gets it out of the system.
Yeah. But speaking of, I don't know, there's no good transition over into, into the next thing. Market performance for the last 7 days, like we typically look at. Nasdaq Composite, Dow Jones, their TLT are kind of bottom three from the performers we typically look at. In terms of upside performers, really not too many. Russell 2000, gold, and then crude. I said those out of order. Crude was the main winner, up around 6.5%, up another few percent today as well at the time of this recording. All the other areas of the market, somewhere in between, essentially, in between 1% up and about 0.5% down over the last week. S&P 500 off around 0.5%.
Yeah, relatively muted action for a lot of those broader market indices. Obviously, some of those different subgroups or subsectors, a little bit more movement, but overall a little bit more quiet, just by a little bit of uptick in some geopolitical conflicts, causing a little bit of some of those oil spikes here over the last week, and I guess since the start of July as a whole.
Yeah, I mean, Ian and I were talking about it last week. We've seen a rotation out of some of your leaders, right? Industrials, technology obviously comes to mind, semiconductors more specifically. Energy had fallen, is now picked up a little bit. Healthcare was a laggard, is now not so much a laggard. Some other areas of the market. So, we're still seeing this rotation that I think is certainly worth watching. We've got a really good lineup of stuff to talk to you about. The first thing that I want to do is highlight actually a piece that you had put together, Trevor. Talking and contextualizing some of the declines that we've seen from technology specifically, right? We get phone calls, the line is blowing up in the Richmond office talking about, hey, what do we do with this exposure? Is technology's leadership done? And while we have seen a bit of waning leadership there, is it enough to say that it's done, Trevor?
I wouldn't say so. For context, I put out this piece here a couple days ago, and broadly speaking, you saw technology is really just the cream of the crop. Within Dolly, it had a lead over industrials by over, dozens of signals, if not way more there for a little bit, and has pulled back a little bit. And so I wanted to provide a little bit more context around that decline. And overall, you saw some of those previous areas of leadership like semiconductors or some of those memory chip names like Micron, really up double or triple digits year to date or just over a few months span. So, with that potential gains and just that sheer magnitude of upside, it take a lot of movement to cause that. And so when you look at kind of the broader technology sector, things are definitely a little bit more volatile than they usually are. I think that's a part of just kind of the AI theme, a little bit of uncertainty around that. And so just to start off, the first thing I looked at in this research piece was just kind of how much movement the technology sector has seen over the last kind of 3 months relative to the broader market. And when you look at kind of the IYW, that ETF for technology, it's been about twice as volatile as the broader market over the last kind of 3 months, which is fairly abnormal territory. Did see obviously the dot-com bubble there, but still some other bullish periods where you saw that much of the early and mid 90s, as well as a little bit of 2017 there, as well as 2024. So not all doom and gloom just from a straight volatility perspective. It's definitely been a lot of movement, but not necessarily too bad. And look at some of the charts here for semiconductors, and then the Round Hill memory ETF, holding some of those memory chip manufacturers like Micron. Definitely seeing a little bit of a downtick here. But the broader sector, I mean, still holding up relatively. I mean, did you want to talk a little bit about some of the decline from those specific funds there?
Well, we can certainly, but I want to actually focus on the chart that you haven't gotten to
Mhm,
yet, which is that median month between tech drawdowns.
mhm,
Using that IYW as a proxy there, those kind of drawdown severities and then kind of the average month between those options or between those pullbacks, very, very interesting to
mhm.
me, right?
Yeah, I mean, we did see a little bit of a big pullback within the broader technology sector there in March and about 4 months since then. But really, the average kind of tech correction or a 10% drawdown or peak to trough decline, you can expect kind of a 50% chance of that happening over about a 4 month span or 4.4 month span. And just about in any given year, you can expect about an 80% chance that there's a technology correction at any given point. And when you look at IYW, I mean, things are only about 7% away from all-time highs, or at least from its closing high. So even with recent action, really aren't in that abnormal territory. So despite maybe some elevated volatility we've seen from the broader sector, which kind of to be expected given how much things have run up, the overall kind of decline we've seen here still in fairly normal and expected territory. And at the end of the day, kind of volatility is the price we pay to invest. I don't want to sound like too much of a legal disclaimer, but the potential for gains is always accompanied by the potential for losses. And so just kind of understanding that we're still, again, in fairly healthy territory, especially as things we're pulling back from fairly overbought territory.
Yeah, it's a really good point, Trevor. And I think people are asking, well, what's the take home here, right? The take home here is that as you're having your conversations with clients, as you're looking at your own individual positions, we need to be a bit more cautious, but just understand that as Ian and I said last week, markets can't go up every
Hmm.
day, right? And so what we're seeing is now that kind of conversation spilling over into technology specifically. So again, we are still looking at technology as a longer term leader, just seeing a bit of spike of near term volatility, and we're getting
Hmm.
the pullbacks that are historically quite normal
Hmm.
to get. Now, furthering that idea, taking a look at some of the other RS relationships that might kind of help out contextualize that conversation, we can take a look, and if you wouldn't mind pulling it up, Trevor, XLK, so just broad
Hmm.
technology in this case versus money market, which is Dorsey Wright's kind of cash proxy on our system. Now, again, we can use this kind of 3.25 relative strength chart to go through and kind of compare those two assets up against each other as I pull it up on my screen as well. But again, what we've seen has been a near term
Kind of pullback. Yep.
pullback, exhale, right? That's something that we talked about. But again, that's been severe enough, in air quotes, to see this relationship reverse back down into O's. In layman's terms, this just means that technology has lost near term strength versus cash,
Hmm.
right?
So seeing a little bit of flight to safety here, and over time, kind of looking at either the column or the signal, still can be additive as opposed to just owning the broader technology sector with XLK. But notably on this RS chart, I mean, is a reversal, kind of the first one we've seen since November of last year, which continued through March. But on a longer term basis, we're still showing some of that RS. It's on an RS buy signal versus cash. So that longer term picture still favoring technology for the time being. And when you look at kind of the performance, depending on whether it's on a column of X's or the RS signals, the signals tend to be a little bit more predictive, or at least historically speaking,
Consistent, maybe.
yeah,
Yeah.
consistent, and kind of been more indicative of where you might want to be. So I think in this case, again, seeing a little bit of pullback, but that longer term picture still holding up for the time being.
Yeah. So again, this is really it was designed to be a quick hitter for the conversation today, but just this adds some credence to that idea that again, pullbacks are normal. We've seen pullbacks many times. What is that? One, two, three, now four times over the course of the last just few years,
Mhm.
and technology has been very strong for the last few years. So again, adding some context to say, hey, from a relative perspective, what we're seeing is also very normal. Now,
Mhm.
another relative conversation I think is worth having, Trevor, has been kind of international equities versus domestic equities, and more specifically, emerging markets versus domestic equities, or kind of core
Mhm.
S&P 500 index funds group. This came across my desk just a few days ago on this reversal. But if you pull up that chart between SPX, so again
Mhm.
the S&P 500, and then emerging market proxy EEM on a 3.25 scale, we've gotten a reversal back up favoring the S&P 500.
Mhm.
Now, the question is very easy here. Well, Miles, how is that possible, right? The S&P 500 is flat, if not slightly down, since over the last, couple of weeks. Well, that's where relative
Mhm.
strength really comes into play, right? Because emerging markets over the course of the last few weeks is down 7, 8%, right?
Mhm.
And so while two assets might be down, right, one is down more. And so that's where we can identify positive relative strength, is looking at which asset is down less rather than
Mhm.
which one is up more. Does that make sense?
Yeah, absolutely. I mean, it is pretty notable. I mean, we have seen quite a run here for emerging markets, and pretty interesting to see that. I mean, um, well, from a longer term perspective, like we mentioned, the signals tend to be a little bit more consistent, and SPX still maintain that RS buy signal throughout the entirety of the last kind of year or so that it was in a column of those. It was kind of approaching levels that it might reverse, but still kind of show that longer term strength in favor of just the overall domestic equity market or the S&P 500. But certainly nice to see a little bit of reversal in favor of domestic equities there. And I don't know if you've looked at the kind of just PNF chart of EEM itself, but it is pretty notable there, just given kind of how much consistent upside we've seen. I mean, really just saw a ton of consecutive buy signals before recently moving back to a sell signal.
Mm.
So I don't know if you have a take on that. I mean, oftentimes kind of the first sell signal after a series of buy signals can be a little bit of a head fake, but definitely have seen some deterioration, at least in terms of its near term picture here.
Yeah, it's a very interesting picture. I mean, we've seen us reverse back down, just like we mentioned, against, SPX, EWI. So we're losing a bit of relative strength. Now, from an absolute perspective, we're still well within a positive trend. I don't love to see us violate that support around some
Hmm.
old resistance. But like you mentioned, Trevor, we're certainly not going to go say the first sell signal in a strong uptrend is the one. From here, of course, we're watching resurgences or attacks back up on those highs at around 71 here on our default chart.
Hmm.
And again, for those of you keeping track at home, always just continue to watch that fund score, right?
Hmm.
That's the most important one. The other thing I'll mention, Trevor, is I do want to remind people that just because we've seen, this one relative shift does not mean that you need to go change up all of your allocation, right? Domestic equities and international equities still sit at the top of our
Hmm.
our Dolly rankings, which is, measuring 6 different broad asset classes against each other. So international equities are still in first, domestic equities are in second, but only 3 signals behind.
Yeah, fairly close behind, and then there's a pretty sizable gap between domestic equities and the next closest group, commodities. So continue to see kind of broad-based leadership from the global equity space.
Yes, correct. It's a very good point. And I think that leads us into our next conversation about commodities specifically. I'm taking a look at crude. Now, I know Ian and I talked about this, a lot last week, but I do think it is worth continuing to talk about this week as well, as we've seen crude, as we talked about at the beginning of the call, gain another 6 or 7% over the last week here, and continuing to move up back on its default chart to the middle of the trading band around that 85 mark. Now, for those of you who missed last week's episode, really the long or the short form of my commentary on crude was that 80 was a pretty
Hmm.
important level, right? Not only was it resistance from the last couple of years, but it was support really throughout this whole conflict in the
Hmm.
Middle East. And so I was kind of using that personally as a sign of, hey, do markets price in more war or less war?
Or mhm.
And so now we're above that point, right? And so I do think it's interesting. Now we're still in a negative trend, still series of lower highs here. But I do certainly think it's interesting that we've gotten back up above that 80 mark.
Certainly. I mean, I think too, you saw a very consistent downtrend there, 4 consecutive sell signals before that eventual return to a buy signal. I think an area I'd like to watch out from here would be that bearish resistance line, coming down to currently $90, would be a pretty notable turn if it's able to move back into a positive trend. Initially moved back to a negative trend there at the end of May, I believe. So again, further area to keep an eye on, but certainly a pretty interesting development. Also bled a little bit over into the kind of broader equity space. Have seen energy funds or stocks in general see a little bit of an uptick. I think XLE, that select sector spider fund for energy, up about 5% over the last week, and then or 4% or so. And then if you look at since the start of July, up about 10% as well. So have seen that kind of impact the broader domestic equity space there as well.
Yeah, and energy in general is still going to be a very headline dependent
hmm
sector. We've seen this, not just throughout this conflict, but really just history in
hmm
general, right? Energy is an extremely volatile group, extremely, headline dependent group. But again, watching a lot of those individual focus names quite heavily, XLE back up above a 3.0 fund score. So
hmm
technically now defendable by our standards.
But
Uh,
still stronger areas of the market and is still more of just a near-term uptick. If you look at Dolly, still continues to be in the bottom half of our longer-term sector ranking. So, yeah, not necessarily an area of emphasis, just one that's seen a little bit of movement here over the last few weeks with a little bit of uptick in that geopolitical conflict.
Yeah, and we don't have to, talk about or look at specific
Mhm,
charts for these guys too. But as we talk about the rest of commodities, precious metals continues to lag behind. Gold has moved back down the new 2026 lows.
mhm.
Similar conversation for silver. So, that relationship is still pretty similar. Agriculture and your industrial metals, your real only points of relative strength,
Mhm.
right? Even industrial metals don't look that good on an absolute basis. They do, at least on a relative basis against something like gold, which is
Mhm.
now down for the year. We don't typically talk around stocks that are about to report earnings, but I do think the conversation around Google is a good one to have, only because there's a lot of these big names that look very similar to the way
Mhm.
Google looks right now. And so, we talk about earnings, right? It's a place where fundamentals and technicals come together, right? Playing the piano with both hands, if you will. So, here at Dorsey, right, we are a technical shop. We're going to focus on the X's and the O's, the price movement, but certainly, the fundamentals are important. And ahead of Alphabets or GOOGO or GOOG, whichever one you want to look at, ahead of their earnings, right? Very interesting. From a price
Mhm.
perspective, we've seen some relative strength leave Google, leave some of the other mega cap options, and trade well off of its highs. So, what do you
It's
think? Is it a good three or is it a bad three?
I mean, certainly want to keep an eye on. I mean, with Google, I mean, and some of these Mag 7 names, they haven't been ones to necessarily bet against on some of these pullbacks. But for the time being, I'd say it's more of a hold than anything. Just kind of see where these earnings shake out here. I mean, still lost some of that near term relative strength, but that longer term picture still holding up for now. Just been a little bit choppy here over the last several months. I mean, had that initial pullback at the end of May, kind of continued through June. And since then, just kind of been up and down, back on a sell signal now, reversed into a column of X's. So I think if you already own it, keep owning it. Big name within most portfolios, but definitely want to keep an eye on. I think is that support level there at about 336 for the GOOG share class.
Got
And so that could be an area to watch. And then still is in a positive trend, but definitely want to watch if it tests that or meets below that bullish support line around the $300 range. So we'll see where things shake out with earnings or just things in general over the next month or so. But a little bit mixed here for Google as well as some of those mega cap tech names.
Yeah, and as Trevor mentioned, right, these are positions that you've got kind of probably long outstanding exposure to, right? And so we're certainly not naive to the fact that just because we're 5-10% off of highs, that doesn't mean that
Mhm.
we sell the position, right? But maybe, like you said, we're just not adding to it as heavily, or we're selling calls against our position to generate some income. And if we get called away, we get
So be
called
it.
away, right? So, there's a lot of different strategies that you could deploy with a lot of these names. Of course, around earnings, there's going to be volatility. So keep that in mind to continue to, help out your clients as we continue through earnings season. I think that's all we've got for today. We appreciate your time. I hope everyone has a wonderful week, a safe week. And we'll also give a quick shout out here as we wrap up the podcast to our annual shakeout event, which is coming up at the end of, was it September? End of September?
Or annual catapult event.
Oh, shakeout. Yeah, what am I?
Different
Shakeout's
events,
another
plenty
event.
events, yeah.
But our annual catapult
event.
event, which is in Nashville, Tennessee, in the end of September.
Mhm.
We'd love to see everyone there. It is for Dorsey Wright veterans. It is for Dorsey Wright beginners. It's for you and me. It's for everybody. And Nashville is obviously a great time. So we're going to throw the sign up link for that. There's going to be more information down there in the description of the video. Feel free to reach out to us, click on that, see if there's anything in there that you that you want to go see, and we look forward to seeing you there. Any other thoughts?
No, I think that's it. Thank you again for tuning in.
Appreciate it. See y'all next week.
Bye-bye.